Is multifamily real estate the ultimate recession-proof asset class? Well, in today's video, we're going to discuss why this is and why you should buy it.
Some of the things we're going to take a look at are how are we valuing our multifamily buildings compared to our residential buildings, taking a look at how immigration is going to impact the value, where market rents are at, how the capitalization method helps, and we're also going to take a look at the scalability of multifamily moving forwards.
Hey guys, Josh Ehren from the Findlay Mortgage team. Today's video, we're going to discuss why multifamily real estate is the absolute best real estate investment right now.
Yeah, if we're taking a look at today's market, there's a lot of economic factors that are really pushing heavy on the multifamily. You got immigration increasing year over year. By 2025, we're looking at minimum 500,000 immigrants coming in every single year. We have, affordability issues with interest rates being up, buyers right on the line being pushed out of a buyer's, being as a home buyer and becoming a renter. Taking a look at, the increase in the flood of renters is increasing, your market rents. So there's a whole lot of factors that are just all pushing and keeping the multifamily market super hot moving forwards.
Let's discuss the most important point here is value. Currently right now, most investors are feeling the pain and pressure in the market from decreasing value in their investments. We just shot a video. If you guys haven't seen it, take a look at it. In our last video that we just posted, it talks about that most investors have lost between 20 and 30% from the top of the market in value, and if you were stuck in a burr or a flip project, you're really feeling that pain right now. Most of our investors who are in the multifamily space, they haven't quite felt that pain, specifically because of how we go about valuing these types of assets. For any of you who don't know, real estate in general is valued in two separate ways. So for the residential side, we're taking a look at the direct comparison approach. That is essentially if somebody else had sold their house in a similar fashion in a similar area, they would take a look at the direct comparison of sales in that area compared to your property, and whatever they sold it for, they would basically boil it down into what your value of your home is. Now, there's a lot of upside to that in an up market, but in a down market, when your neighbors are selling their homes at a discount, that'll drop the value of your home down, which is what we're seeing right now in the market. Now, for multifamily, the valuation is derived from a capitalization approach. What this is we take a look at the net operating income and a cap rate in the area, and then we derive the value from that. The great thing about that is cap rates haven't expanded in the same way that valuations have dropped in the residential real estate market. So what's happening is rent is increasing at such a rapid pace because renters are getting pushed into this market that cap rates are staying decently consistent, which is why the majority of people in multifamily right now haven't seen any decrease in value.
Yeah, a lot of great points there. I think my favorite thing is, just how we're valuing these multifamily buildings. We've seen appraisal after appraisal come in anywhere from, 25,000 to 100,000 under on our residential approaches. But when we're looking at our multifamily buildings, when you go out and you buy that building and you turn over all the tenants and your NOI goes up 100 grand, your value is going to increase proportionate to your rent multiplier. So, there's just so much value on the multifamily side. And when we take a look at, how these buildings are valued, and then we compare that to some of the markets and some of the economic markets that we're seeing right now, in a down market or in, a recession type market, when you're taking a look at home buyers and the shift of people who can afford a home being pushed into, the rental market, we're seeing that flood of renters increase the market rents in areas, which means that, you're taking a look at your building and your value on paper as the market rents are going up and up and up. Technically your building value on paper is also going up. Now, obviously, you don't realize those gains right away. It takes, on natural turnover, maybe 3 to 5 years for a tenant to be naturally turned over. But, if you have the patience and you can wait that out, you buy a building today, in the next 3 to 5 years, as these market rents are going up, you're going to see, a significant increase in the value of your building. And I think moving forwards, as these interest rates do stay a little bit higher, the recession continues, immigration floods, I think the value of multifamily is just going to start going through the roof.
Completely agree. I think the opportunity right now in this market cycle, as we come up out of this recession, is going to be one of the last times that a true, starting investor is going to have the ability to purchase multifamily real estate. Price points right now are decently low. The majority of owners of these assets are legacy owners. They bought this stuff 20 years ago for 100 grand, 200 grand, and they're holding it with giant equity positions in these properties. One of the advantages of being able to purchase these types of assets in this upcoming market is the flexibility it's going to bring from a buyer's perspective, because most of these investors who own these assets are going to have to be creative to allow other investors to come in and purchase these properties.
Yeah, and we're seeing a lot of sellers, because they bought these buildings, 10 years ago, they're buying these buildings, under $1 million, now selling them for, $2 to $3 million, because there's such that large capital gain that's going to be coming. A lot of them are driven and motivated to provide some sort of seller type financing. So, if you're in that position where you're looking to kind of leverage that, moving forwards is going to be a great opportunity to pitch that to the seller, take advantage of those VTBs. And on the commercial side, it's really one of the only conventional types of financing where you're actually allowed to have secondary financing on your purchase, as long as the numbers make sense. And you can't do that on the residential side. So there's just so many benefits to the commercial side. And I think lots of VTBs moving forwards. And if there isn't a VTB available, we can always put a second mortgage, some sort of private second mortgage behind there, which essentially does the same thing. But again, lots of creative options for our commercial buyers.
One of my favorite things about multifamily real estate is the scalability of it. Any investor who's in the residential market right now understands that we take a look at your qualification based off your gross and total debt servicing ratios. You can only make so much money, or if you have the ability to increase your amount of income that you claim in your T1, you only want to claim so much money. So, we have a lot of clients come to us with 4 or 5 properties who are like, well, Scotiabank said I can't buy anymore, or my TDS doesn't allow me to buy anymore. This is the natural progression for most real estate investors who are looking to scale, because it's based off the actual asset itself. I always say this, but the qualification is based off the asset itself. The approval is based off of everything. It's a very holistic view. So you as a borrower, it's very important to have a strong borrowing profile, but the scalability of it and the ability to be able to continue to buy and scale your portfolio without hitting all these financial roadblocks, this is the natural progression. I think in the last year, we saw 1 in 5 transactions happen with a real estate investor. And honestly, it's unfortunate, but I think that as the gaps start to shrink in this market, and the middle class essentially either gets separated into the upper class or the lower class, there's going to be a push between the people who are buying and the people who aren't buying, who are renting. And I think that the investors are going to start buying more. I think you're going to have 2 out of 5 and then 3 out of 5 transactions, all to do with real estate investors. And what I do is I take a look at what's happening in the States right now. The States primarily has DSCR loans. They have these DSCR loans that are based off of the actual asset and how they're operating. I think we're a little bit behind where that is, but we're going to see a progression towards those type of loans. And as we start to see a flood of real estate investors predominantly making the transactions in our market, this is the type of financing that's going to honestly dominate the investor space probably in the next 5 years.
Yeah, and I think that's one of the large advantages that multifamily and any sort of commercial has over residential. Whereas if you're going to a bank to get financing, your property has to cash flow. You have to be making some sort of positive net income, annual or monthly, however you want to take a look at it. Whereas on the residential side, your house or your 2, your 3 unit, your 4 unit could be negative $500 a month, but if you have enough personal income to make up that difference, you can still go ahead and qualify it. Now, that's great if you're looking at building some sort of net worth or just equity type based portfolio. But if you're looking for a cash flow and you're a cash flow investor, having a portfolio of 5 to 6 properties or 10 properties that are all short cash flow every month isn't doing anything for you. Whereas you can scale that on the multifamily side. Lenders aren't giving you a loan if it's not making money. So you walk away from your transactions with a true cash flow positive property. And there's lots of different financing options on the commercial side as well too. We have the CMHC financing, which is going to give you your top end takeout, where you're 85 to 95% loan to value, 40 to 50 year AM, depending on the type of product that you're going with. Some of these products too are, if you're taking a look at the MLI Select, which has been a big hot topic over the last year, taking a look at that energy efficiency side, if you're refinancing into CMHC to do the renovations, they're giving you the money based on that increase in equity to do the renovations, and you're decreasing your costs of running the business at the same time. So, kind of a twofold effect there. We have A lenders or or kind of like a B lender that is providing, you know, good loan to value, 75%, but they're also providing, you know, funds for your loan to cost as well too. So you can get your purchase price, your loan, and then you can also get some CapEx to help you turn over the building in terms of turning over your tenants, to help do some renovations. You know, we have these products on the A side and some of our private lenders as well too. So there's just a lot of products out there that are geared towards the commercial side, way more creativity than some of the residential products.
I agree. And when you're assessing your portfolio, you have to understand that if you have a portfolio of, let's say, single family homes in the GTA area, and somebody stops paying your rent, that very quickly becomes a you problem. As investors start to grow out of that residential space, they start to realize that you're diversifying your risk as well. You know, if you have a building that has 10 units and one person stops paying rent, that's no longer as much of a you problem as it was if one person stops paying your mortgage on your entire building. So as you start to progress and you start to realize that, you know, instead of having 10 roofs and having 10 property management contracts with your property manager dealing with all your properties, if you can consolidate that, reduce your risk of having people not paying your rent or having additional expenses on your portfolio, this allows you to be able to truly scale in a way in which, you know, most generational wealth is actually created.
Yeah, I completely agree. I think, you know, as we move forwards in, you know, the new year, these commercial lenders, their books are resetting. So, you know, they're going to be aggressive, they're going to be hungry, they're going to be more likely to give you a little bit, you know, stronger valuation and, you know, loan structuring. So as we start off the new year, you know, start just running these deals by us. We can flip it by our lenders, you know, we can run the numbers, we can take a look and see where they're at. But the lenders are going to be aggressive as we start the new year.
Completely agree. I think that, you know, as we see cap rates slightly expand, you know, that push into the rental market is going to keep the valuations of these properties strong. Buyers are going to continue to buy, projects are going to continue to move forward, and the lending products that are out in the market right now, they're being pushed into this type of asset class because most lenders understand that the value of these assets are going to continue to hold throughout this recessionary period. Now, if you guys have any questions about anything we spoke about today, or you have a very specific situation that you'd like our opinion on, feel free to reach out to either Ehren or myself. We're always available and happy to connect. If you like this video, please hit the subscribe button, hit the like button. It allows us to be able to create more content like this for you guys. Again, if you like this video today, please hit the like button. We appreciate you all. Talk soon.